All
Amazing.
right. Hello, everybody. Hi, David Gertz from Mortgage Alliance. How's everything going with you?
Oh, fantastic. It's been a good day so far. It's beautiful out there. Looking forward to a nice weekend. So yeah, we're excited to be on the call today. Thank you for having me. It's
Oh,
awesome.
you're very, very welcome. You actually, because of your webinars, propelled me into doing these Friday morning chats, and they've been extremely successful. And I've had various industry leaders on the
Mhm.
chat with me, and they've been well received. So today I wanted to bring you back and
Amazing.
pick your brain on what's been happening in the market. How about we start with that? What's happening right now?
Well, we definitely been seeing a lot more activity, and it's which is nice. We had, one of the really good things is we're seeing our submissions go up a lot, especially in the last 3 to 4 weeks. Especially if you look at April over May, there's a really good increase in submission numbers, which is a really good thing. And it just even like I noticed like the last couple weeks in general, like I'm busier. More agents are in contact with me because I'm some like just there's more activity coming in. We had Deli Oliveira on last week and on our call on Wednesday, and he has 4 different REMAX offices in Cambridge, Guelph, and he has 2 in the GTA. So it's a good cross section.
Yeah.
And he was saying they really track appointments, and he brought up a graph, and he basically showed us that their appointment level is almost back to where it was pre-COVID. So,
That's fantastic.
which is a really good thing. We did have a supply problem going into this. So you know what, there's definitely some pent up demand that's going to be there. It's going to be interesting to see what happens on prices over the next month or so. But definitely there's a lot more activity. All the agents and mortgage brokers that I deal with are saying it's busy, everything. We're seeing multiple offers and stuff, right? So that's a good thing.
Yeah, I can attest to that. We've been pretty busy. It seems pretty much pre-COVID for us right now.
Mm-hmm.
Anybody who put a halt on their either private lending funds or
Mm-hmm.
borrowing, pre-approvals, that sort of thing, they're coming around again just to check in and see if their numbers are still valid. So that's been really exciting. I know my underwriter Victoria has been hopping with pre-approvals again, so that's fantastic.
That's
Um,
awesome.
yeah, it's been great. So I wanted to talk to you about some of the changes that we've been hearing, and let's go back a couple of weeks with CMHC and some an announcement that perhaps was misconstrued, misinformation. So we'll start with that, and then we'll get into their announcement just the other day.
Yeah, it kind of started. Evan Sedell about 2 weeks ago basically made some comments, and he was, in front of our parliamentary committee, and he spoke for about almost 45 minutes. And he had some comments, and he made them, and unfortunately he misspoke. And then the media came and actually took them, and of course, before he corrected himself, the one big thing he started out with, he said, 12% of Canadians' mortgages are in arrears. And what he meant to say was 12% of Canadians are actually in deferral. So he later corrected himself to say, oh, no, sorry, I meant deferral. And then again, though, later on in his thing, he said arrears again. So the media took that, and he also, another big comment he made was, prices, they're forecasting prices to come down between 9 and 18%.
Yeah.
And then he said, well, if that's going to happen, you know what? You should maybe be increasing the minimum down payment to 10% from 5%.
Mm-hmm.
So now he somewhat sidestepped from those comments. He said, we're Paul Taylor from our Mortgage Professionals Canada had a chat with him after that, and he had said, no, we don't have any intention of doing that. But of course, a lot of the media, like every media outlet you took, then said, oh, housing prices are going to come down between 9 and 18%. And the whole thing is he hasn't really, how have you forecasted a downturn in 9 to 18%?
Yeah.
When we had a supply problem coming into this, we still have one. And if you look at every major market, the prices, you haven't seen really any really softening in prices. If you would have thought you would have seen it at least in May, and you didn't, and we saw activity, and now May was still down. Activity sales are down year over year,
Yeah.
but activity in sales in May was up almost 50% over April, right? Which is a really telling sign. But I think that's it. So with just a lot of people, took a lot of heat, from those comments. But then, of course, led into them making some changes last week, right? So
and that's pretty interesting, making those changes last week. I mean, in the industry, it was like every time there's a change, we know that consumers' confidence goes down and they go in hiding for another little while. But what were those changes? Let's start with that, and then we'll proceed with the good news about the other insurers.
Yeah, so it was obviously a big shock, and because what they came out with late on a Thursday, last Thursday, that they were the big one was they're decreasing the serviceability ratios. And what those are is when you apply for a mortgage, our lenders, they look at a ratio, and it's debt to income. And at CMHC, if you had a minimum beacon score of 680, they would allow your housing payments, we call it your GDS, your gross debt service ratio, to be up to 39% of your gross monthly income. And they would also allow all of your debts to be up to a maximum of 44% of your gross monthly income. Okay? Mm-hmm. So what they did is the big change is they actually reduced those metrics. So they said now going forward, if you look at your housing costs or your, we say shelter payments, your GDS ratio, that went from 39 down to 35, right? Then they also lowered the total debt service ratio, so all of your debt as a percentage of your income, down from 44 down to 42. So the GDS one is a really big thing. Secondly, then they talked about people can no longer use your down payment has to come from your own resources. Now there's a little bit of confusion on that, where CMHC we're still waiting for some clarification, because what used to happen is you could put 5% down, but if you wanted to get to 10 or 15%, you could actually borrow more funds to get to those lower, higher down payment thresholds. So that would also decrease your CMHC default premium. So that was a really, really big one that they talked about. They also talked as well. Now this wasn't really a huge one. If you have a multi-unit residential property, and you're refinancing it, you had to use the proceeds for that property or to purchase another one. So that was a really big one. And another one, well, that wasn't really that big, to tell you the truth, sorry. But the other one was the minimum credit score for a borrower, of one borrower, had to be 680, right? So now the only thing with that is I spoke with them, and they also removed, though, the secondary borrower used to have a minimum credit score of 600. They've actually removed that. But the biggest thing of all the changes is, of course, the debt service ratio. Going from 39 down to 35 is a big, it basically just talks about affordability, right? And who this really hits is your first-time home buyers. The housing market, housing prices have, crazily outgrown the pace of increases in salaries. Right, so that's, you really feel sorry for someone who's getting into the market. I know last year, I think if we looked at our first-time home buyers, I think it was almost 68% of first-time home buyers with us either had some sort of mom and dad, a co-signer or down payment coming from the bank of mom and dad, right? And it is what it is. Like, it's just, I tell the story, like, like when I bought my first house in 2002, I worked at the bank at a time. I was an assistant branch manager. I think I made at the time maybe $53,000. I bought a home here in Cambridge, which is now a rental. I paid, I think, $160 for it. So now flip ahead, 2020, 18 years later, that same house is now $525, but that same job at the bank
is the same,
56, 60 grand at most. And that's if you're hitting your goals. So that's a huge gap, right? Like, that house is almost basically over tripled, and salaries 8%, maybe. Right. So you really feel for the first time home buyers. So that was I talked with Paul Taylor after that. He's the president CEO of Mortgage Professionals Canada, and Paul's a very even-keeled man. And usually every time these changes come out, he's level-headed about it. Well, it's he takes it. He takes both sides of the story. But it was the first time that I'd ever heard him be frustrated, just because their biggest job is government relations. That's what they do. Is they're in front of government to educate them what's happening in the mortgage industry, to give them stats so they can hopefully make an informed policy decision. So that's really, really important, right?
So why do you think that CMHC is targeting the first time buyers? I mean, my theory, first time buyers are just getting into the market work wise. So maybe higher risk because of COVID and not being able to hang on to those jobs because they're the lowest on the totem pole, for example, and not wanting to put their insurance to back that type of a risk. Would you think that that would be a fair assumption to say?
Well, I think unfortunately it's just an unintended consequence, because if you read their release, they're basically like, their job is to protect the taxpayer, and
Yeah.
they see risk in housing going up, right? But it's kind of, well, when every other level of government is throwing billions and billions of dollars at the economy to make sure it stands, and yet they take it away from housing. And housing is such an important driver of our economy. I think I told the story on our webinar on Wednesday, but like last Saturday, recently we had 2 people move in on our street. And on Saturday alone, it's funny, so out there cutting my grass, but you realize it as an insider. So these 2 people just moved in. One of them, they had tradesmen in there doing work in the inside of the house. The other house, they had landscapers doing some landscaping and all that out front. Both of them that day, there was Leon's and the brick coming in, delivering new stuff. Like the spin, I'm like, wow, like you don't see the spin-off effects of housing in our economy is huge, right?
Yeah.
And in a time when they're doing everything they can to prop up the economy, one of our staples of the economy is they're taking down. So that's where I think the frustration comes in. Is like, they're saying, yes, they're there to protect the taxpayer. Well, if that was the case, then why are you throwing $2,000 to anyone out there in the entire country who applied for it? Now you have a problem. You have to go chase all these people who didn't apply for it. So, that's the frustration, right? So obviously there's more there to it, but yes, they're there to protect the taxpayer and protect us. But it seems like we're getting 2 different messages as we come through this.
Yeah, for sure. But there's good news in this. CMHC, Canada's Housing and Mortgage Corporation, isn't the only insurer out there. And the next day, we heard from Genworth and Canada Guarantee, and they adamantly oppose this, and they're not going to pursue the same policy changes. So that's really good news.
It was great news because, and it's funny because it was just my knee-jerk reaction. I thought they'd all be following it.
Same.
But if you look at it, usually this change came from CMHC. It didn't come from the Minister of Finance, right? So if it came from the Minister of Finance, all the insurers would have to come into play. So this was a company decision that they made, right? So just like one of our lenders, First National, they changed their policies. Well, that doesn't mean all of our people are going to change their lending criteria. So CMHC did. That so our other 2 insurers, Genworth and Canada Guarantee, who are private insurers, now can still play into that market. So that's a really good thing, because Paul Taylor was talking with Evan Siddall the day after he made these changes, and he asked him, he's like, of those changes that you now took away, what percentage of your book, or what percentage of your business did that represent? And it actually represented almost 25 to 30% of the transactions that they did through CMHC. So if the other insurers didn't come on to take us, it would be a pretty big effect, right? It would have a pretty big effect on a number of people having housing and coming into the business. So it could have had a really big, obviously, negative effect on the market for sure.
And as mortgage brokers, like, we have the option now, we submit a deal, first time buyer, and it hopefully will work through one of the other 2 insurers rather than just relying on CMHC to take this on. I mean, I think we figured it's about 11% reduction in housing.
On the GDS, it is. Yeah. Here, what I'll do is I'll share my screen if you don't mind here.
Yeah, go ahead.
And I'm just going to show you this one chart I put up on our internal page, and it's pretty cool. And it's basically a chart, and what it looks at since 2006, it actually plots real estate pricing compared to all the different mortgage rule changes over the last 15 years, right? So basically ever since 2008 that's when we had the financial crisis in the States. We've seen, a pretty much, other than like this year, we've seen, we were supposed to have some tightening on the stress test. That was kind of taken away when this came in, but we've seen a number of just mortgage tightening. right?
Yeah.
And if you look at every time that there is a change, well, you see a bit of an increase right before because people rush into the market to beat the changes, right? And you see a bit of low, but then housing goes up. You see a change, okay, then we see a little bit, you know what, a little stagnation, not even a decline, but a stagnation, and then we go up, and the government changes again. So housing prices in Canada has been very resilient, right? And it's just, you know, we believe to it, it's just the fundamental way that mortgages are underwritten now. It's extremely sound. The amounts of, and you know it, we live it every day. The amount of documentation that goes into underwriting a mortgage file to put it together, it's extremely onerous, right? And especially a lot of consumers, you know, we have been lobbying for the last, 5-6 years, and we finally, you know, we were getting something coming in, and I think we're going to get a bit more of a loosening as we come through COVID because affordability for first-time homeowners.
Yeah. Well, we were down
the
that
prices
track,
are
right?
quite resilient.
Yeah, we were going down that track, and then COVID hit because we were all waiting for April 1st and the loosening of the stress test. And of course, that didn't happen. However, we did see just about a week ago, was it, that
Benchmark rate, qualifying rate.
Yeah, so you know, that was good news.
Yeah, and for most people,
not all doom and gloom.
No, and see, like, and one of the changes that the government's made about 3 years ago, they called B20s, is when you apply for a mortgage, you have to qualify, even though we get you, say, 2.25 or 2.35, you have to qualify to carry your mortgage payment at what they call now the benchmark rate, they do a stress test on you. You have to qualify way above that, and it was at one time, it was 5.19, or now it's down to 4.94.
4.94, yeah.
Yeah. So the nice thing is that that's come down a bit. So well, it's funny because that came down last week, so that helps affordability a little bit. And then
right.
But yeah, so we've seen, and the amount of, like, you know, the stress test that they come in to, you know, make sure, you know, they want to bring in a stress test, even though yes, you're getting 2%, 2.35 on your mortgage. What happens if rates increase? Well, and if you actually look at the math, well, if you take a 5-year mortgage, you know, the average appreciation in housing over that 5-year period, just look at this graph, right? Mm-hmm. Take any 5-year period. So you go from here, you go up here after, you know, a 5-year period, look how much more equity you now have in your home. So if you're now renewing after that 5-year period, your equity has come up a lot. Probably over that 5-year period, your income is going to come up quite a bit as well. Yes, you have some, you may have some more debt, but your debt to equity ratio is going to come down quite a bit. So on a 5-year mortgage term, to stress test someone 2% right after is, you know what, it's anyway. So at least they are asking, you know, we're going to be addressing that a bit. So we saw it come down, and I think as we come through this, will come down. Question here. So Matt on Facebook, would CMHC premiums go down if the TDSR is now to be a little bit more manageable since it's forced down as well? Have the premiums come down? No, that hasn't happened yet. The government is still, you know, taking the same amount in their premiums. You know, you're technically right because they have less risk. So you know what, they should. That's an excellent point. But hasn't happened yet. So that's you know, that's a funny thing. Well, great. You know, you're taking on less risk. Why don't you charge me less money because it's less risk for you, right? So. Yeah. That's a very, very good point, Matt. We haven't seen that yet. I don't think we'll be seeing it like that until we come through this. But you know, the next couple of months will tell. You know what, if you know, if there's a second wave here or something like that. In Canada, yes, knock on wood, looks good, but we still have to be careful to make sure we're not, you know, moving too quickly. You know, a lot of Canada's open. The GTA still isn't open yet. Niagara region down to you guys, and you guys aren't open yet. So you know what, I think it's good we're taking a bit more of a slow measured approach. The States is a little scary, you know, with all the protests and stuff that have been going on. They've seen, some states have seen an uptick. So the financial markets had a huge, colossal down day. I think the Dow was down 1,800 points yesterday. It's back up today, mind you. So last time I checked, I think it was up about 600 or 800 points. So it's almost half the gain. Yeah. So right now, the Dow's up.
We have a financial consultant on if we want to bring him on and see where.
Yeah, so right now it's up 183 points. So it was up a lot. Now it's come back down. So yeah, so that's, you know, that's the stock market's always a good kind of you know, a good predictor of what's going to happen. It's a leading indicator. But that being said, the financial markets have come up they're basically almost at par to where pre-COVID was. So it could be kind of say that it was due for something as well. But yeah, it's interesting times, that's for sure.
We have a question here. I have a mortgage renewal coming up. Should I look at fixed or variable? Rates are so low, I'm not sure what to do.
Really good question. You know what? It's funny. I'm a huge variable proponent. And I always say that just because it's two things, right? Normally I'm a big variable component, but the problem is right now the discounting on variable rate mortgages aren't that good. Even though prime has come down a lot, you know what? The discounting, you know, the best out there is like prime minus 3 to, you know, there's some other rates out there up to, you know what? Before COVID, we could get you almost prime minus 1. Right, so right now you'd be at 1.45, which is crazy.
Yeah.
Fixed rates are extremely low right now. You know what? If you can get something fixed rate below, 2 3/4, that's an extremely good historical rate. The biggest problem, of course, with fixed rates is their prepayment penalties. Right, if you want to get out of that mortgage before your term is up, especially the bigger banks, you know, like we just put an article up. Rob Cuddick from Globe and Mail talked about the prepayment penalties from the bigger banks and how they are so punitive. Then I sing about a variable rate mortgages. You only ever have a 3-month interest penalty. So if you need to move, refinance, and do something, it's a lot more flexible of a product. So you just, you know, what's the right answer? It depends. You know what? You have to look at your own situation, what you're comfortable with. If you're a bit more conservative and if it's going to stress you out about getting a variable, take a fixed. You know what? If you know, even look at your own scenario. Like you know, the average Canadian does something on their mortgage every almost 30 to 36 months. So about 2 to 2.5 years is about the average time. Well, if you're going back every 6 months or something, and you're refinancing or moving or something like that, then maybe you should be looking at a variable, right? So that's a discussion you'd have with Angie, and she just go over your basically what's right for you.
Follow up here. I see a lot of ads on Instagram about rates of 1.99. Can you tell me, is this real or just plot to get me to contact them?
No, there is a 1.99 out there. HSB does have it. It's a pretty good. It's a good offering. We have lenders at 2.15. The HSBC, they're also, depending on the mortgage amount, they're offering some cash back. The caveats to that is it has to be like a AAA deal. It was funny. I called into them just to get some more information, and I was on hold for about half an hour. So I asked them to call me back, and they called me back about 4.5 hours later. And basically I said, I asked him, I said, my mortgage is closing in 18 days. Is that okay? He's like, no. He goes, we need anywhere from 5 to 7 weeks to close a transaction. So yes, the rate is good, but it's like anything. Like when the rates are that good, it's going to be a little bit more painful, right? So, we have a lot of different lenders depending on what you're looking for that can get stuff done a lot quicker. So it just depends. But yes, those low rates are for clean AAA deals. You have to have external credit, deferrable income. So it's for a different part of the population, that's for sure.
And my understanding also is from some digging we did, you need to have at least 100K in other assets that you're at that bank, as well as a savings account of at least 25K. So just, it's out there. Like David said, it's a AAA, if not higher, client. 700 Beacon score, like it all has to match up. So
definitely, yeah, it's for your AAA, and that's normally what what we see is we have a lot of lenders that offer low, like no frills rates. But again, and what we tell people is we can get you that, right? But it's going to probably be a bit more painful because there are very, very sticky. We have a lender, maybe your rate's a bit higher, but guess what? It's going to be a lot easier access, getting it done. It's going to be quicker. Yeah. So, it's up to you, to the client on what they're comfortable with. And more importantly, it's okay, well, what can you get qualified for? Because these lenders are extremely picky in what they'll deal with. So it has to be for a very, very clean deal. So
Yeah.
in this market now, sometimes you don't get a choice just because it depends. Like, what's your income like? What's your down payment? What's your credit? Where's it coming from?
Yeah.
Do you need a co-signer and all that kind of fun stuff?
And I've adopted the line from Claire Drage. What's important to you, the interest coming in or interest going out. So what are the fees at the end of this all? So usually those low rate basic mortgages come with a hefty breakout fee. And like David mentioned earlier, every 36 months or so, we know clients are refinancing. Whether they think so or not, there will be a life event that will cause that. We see it. It's historical data, doesn't lie. So it's so extremely important to know what is going to happen at the end of that mortgage when you're refinancing.
And it's so true because and people always ask they ask me this, look at your own situation. Are you in exactly the same situation you thought you'd be in 5 years ago or even 10, right? Not many of us are, right? So think about that. So life changes. You want to have a mortgage that's just as flexible. And that's the thing, you get a low rate right now, but in a year and a half, and I have a job change. There's a pandemic. My work shuts down. I can't make my mortgage payments anymore. I got to switch. Whoever thought we'd be in this situation right now, right? So it's what a lot of unfortunate people don't think of is, okay, what am I going to do on the other end, right? And even like us, when we're working with clients, if you have a variable rate mortgage, it just gives you so much more flexibility on the back end, right?
Yeah.
There's been not many times in history where it's really ever paid you to take a fixed over variable, right? There's been a couple times, where but historically the math usually points to always taking a variable. But again, just because the math says that, it doesn't mean it's right for you. It's like investing in the stock market, right? I can tell you all you want. If you keep your money in the stock market over the long term, you're going to win. But some people can't handle the little ups and downs. They can't handle what's going on right now. So it's if a good question to ask yourself, and I know Angie, you do this as well, is if I sell you a variable rate product, and if prime goes up right away, are you going to call me then and say, hey, I want to switch back to a fixed, it's going up? Well, if you're going to say yes, you're going to switch, a variable is not right for you because you're not going to benefit from the savings. Because yes, prime goes up, but it comes back down. Up, you're not going to benefit, because when you go to lock in, if you're in a variable rate, the lender will let you at any point lock into a fixed. But when you lock in those fixed rates, you're now higher. Now you're locked in for however many years remaining in your term. You've lost the benefit of the savings of being variable.
I had speaking to a client the other day who was in a variable, locked in a couple years ago. He was a variable, and he was like, it quickly went up. That was during the time when we probably had gone up, prime went up about 75 points or whatever. And he's like, my payments went up by $100, $150. We got really nervous. But how about now? I said to him. He said, well, what about now? I said, the prime rate just went down about 1.75. Your rate is probably about 1.3. He's like, it is? He had no idea that prime, what had happened to his mortgage. He was concentrated on what happened a couple of years ago when it went up, that he didn't even realize that it had come down. And so those who locked into a variable couple of years back, even 3-4 years back, they're laughing right now. Even up until October, November, we had variables of 1 point off of prime. Those people are the ones that are laughing right now. So it is a long haul. You might see some increases, but then, the benefit of the whole term is really what you're supposed to be looking at. I agree with you right now, David. Is this the right time for a variable? I mean, it all depends on the whole file. I agree. Depends on what life event is coming up. Are you going to stay in the property in the next, 3 to 5 years? Are you going to stay there for the full 5 years? Are you planning to have a family? These are the discussions we have with them. And just this week, we've had a couple clients who know for certain that they're going to be moving within the next year and a half, 2 years, variable all the way. Because going into fixed rate, you're going to have a hefty penalty at the end. Nobody wants to see that happen. So variable, is the advice that I gave the clients. But if you're going to stay in there 5 years, we know that the Bank of Canada is going to be bringing up that prime again. We know that that's going to happen within the next 5 years. Is it the right choice for you when you can lock in that 2.2 on a 5 year? I know. Good discussion though. Thanks for that question. It's a long answer to, what always people think is a simple answer, and it really isn't.
No, yeah, and it's very person specific, and I think like if you do the math, it's most of the time it works out for you from mathematically to take a variable.
Yeah.
But then again, does that mean it's right for you to take a variable? It depends, right? If it's going to stress you out, and it's just like investing in stock markets. If it's going to stress you out, seeing your investments going up and down, well, then you should have a lower risk portfolio.
Yeah.
But the good analogy I say is somebody, like they say, a fixed rate they say is a conservative product, right? It's more conservative because you get to know what your rate is. I disagree. I think a fixed rate is more risky than a variable because of the prepayment penalties on the back end, how much interest you pay on the back end. And I've seen so many situations where clients come in, as Angie said, they have a life event, they get laid off, they have a critical illness, they have a death in the family, life happens, and when life happens, you want flexibility. So yeah, it's a pretty big thing that you want to work with to make sure you have flexibility. So that's the big thing about the variable.
Yeah.
Or when you do the fixed is unfortunately, especially with Canada's 5 big banks, their prepayment calculation, their prepayment penalties are extremely punitive compared with a lot of other lenders that we deal with. So and that's something that we have to weigh, and we'll go over with you. And Rob Crick, and I think Angie, if you want to put it up on your Facebook page, talks about the article about let's see if I can find it here, about how to work. 1 second. The differences in penalties when it comes to being on to working with the bank, right? It's pretty crazy sometimes. But you know what? It's because the story they ran with, because there was a
the real estate agent with the $30,000 with a $30,000 penalty, and with a fixed rate. But she basically she didn't even move into the property. She was it was like months into it, and deferred her mortgage, and then wanted to break out of her fixed rate mortgage.
Yeah, and here it is. And I think, Angie, you can put up an argument for not getting your mortgage at a bank, right? And it just basically goes in and talks about, how they have a higher prepayment calculation, and just really, so you're aware. It talks about, and Rob Peck's a great run as well. So it's a really good read, because obviously just don't think, they think, oh, the penalties. No, it's not. Like, every lender has a very different calculation, and it's not regulated, from lender to lender on what they can pay. And unfortunately, you get your mortgage, you get your low rate, you're like, oh, great. And we don't look at the fine print and realize, and and that's the big thing. Until you get burned from it, you don't. And that's what we tell people. And the question we ask, okay, when was the last time you did a transaction on your mortgage? Great. You were just in here 11 months ago. Why are we doing a fixed rate? Right? Or you were in here 2 years ago. Why are we doing a 5-year fixed rate for you? It makes no sense.
Yeah.
Right? And you can say what Claire says, you cared more about the money in or the money on the back end, right? Or if you're paying, right? So that's where you can really, get into it is on the prepayment penalties, right? So, and that's where we try to do our job.
Okay, I'll get that posted on my page afterwards. We're just over a half hour here, David. How are you for time? You're good?
Yeah, I got another about 10 minutes.
Okay, all right. Well, we'll see if there's any other questions. Victoria, if you can check Facebook to see if there's any other questions. This has been amazing. Thanks so much, David. Maybe we can wrap up with some industry insights, trends, or anything that we're anticipating. Is there anything coming up in the pipe?
Well, again, with this, you'd like to say no, but I think the next couple of months will tell, like in terms of how housing goes, what happens with prices. I think we're definitely going to see some more supply coming in now because people getting more comfortable. You know what? So it's busy now, right? So it's you know, it's definitely picking up. You know, we're getting to the point now where, you know, we're seeing a lot more activity. People are just are getting back out there, so which is a good thing. But again, it's going to see how the cases come in. Are we going to see a second wave? That's going to determine where things go. But if it does has a bad hit, and then CMHC realizes, oh, we tried to slow down housing and made it even worse, so they could exacerbate the problem, right? So it's that I think as we move through this, you know, they had a stress test reduction. You know, I think that will get revisited, you know, for the certain people, and so that's a good thing. But it's just, you know, we're trying to get back to what our new normal looks like, and that's going to take some time. But yeah, in the near term, yeah, like, you know, Evan said, he's leaving CMHC. Actually, I think he's done next week, so he wanted to go out with a bang, apparently. So
yeah, I think so.
that he did. So, but again, so, you know, Genworth and Canada Guarantee are still committed to you know, having those programs in. So that's a good thing, especially for our first-time home buyers, because it would have been pretty tough.
Yeah. And I think the new trend is going to be what we're getting used to here is the Zoom meetings with our clients. I've been absolutely loving them. You know, you've heard me say that there's no way you would have caught me on video, you know, 3-4 months ago. And we were doing so well that I didn't want to lose momentum. And I thought, I've got to pivot, and I got to, you know, just suck it up and get on video. And it's been the best thing for our business. We're live on Facebook right now. Like, who would have thought that before? And it's been brilliant, and I can't see myself going back. I can't wait to meet for coffee chats instead of face chats like Zoom chats. But this is definitely going to be integrated into our business, and it's been so efficient, David. My underwriter, I have my pre-call first on Zoom or phone call if that's what the client wishes. We upload our documents on a safe portal. Our underwriter reviews everything. Then we have a follow-up phone call on Zoom. We have DocuSign. The efficiencies that this has created has been amazing, absolutely amazing. I can't imagine going back. So I see that continuing, at least for my business.
Definitely, and even for myself too. Like, and I've been so proud of you and how far you've come with it, with your stuff. It's just amazing. Very, very motivating to see. You know, you a powerful businesswoman like yourself take it to the next level, and working with Victoria. Like, you guys are just doing awesome stuff. So I think that's really, really good. And even like myself, like before we came through this, I wasn't. I never did videos and stuff on Facebook. I wasn't. It's something that they had recommended we do, and I just didn't think it was me. I didn't think it would be genuine. But the amount of feedback and the way you can connect with people is just crazy, right? So it's a really good way to connect with people, because we can see each other. You know, and there's just been so much information coming out lately. People like the little updates and reports. So yeah, it's for me, I found it's been a really good kind of a growth experience as well. You know,
it's been good in a stressful time. There's been some really good things about it. So anyhow, David, it doesn't look like we have any more questions here. Awesome. Thanks so much, as usual, for all your insight, for all your guidance and support of the Pettyjohn team. Any questions that anyone has, please reach out to us. You can find us on Facebook, Instagram, or the old-fashioned way by phone call, 416-970-9107. Awesome. Anyhow, thanks, everybody. Thank you, David.
Have a great day.
You too.
Thanks,
Bye now.
Angie. Bye, Victoria.
Bye.